Dodla Dairy, the second largest player among private dairies with a significant presence in south of India, is poised to continue outperforming the dairy industry. DDL is tapping both organic and inorganic routes for strengthening presence. The recent acquisition of Sri Krishna Milk's operations would also consolidate DDL's presence. The company has created a strong relationship with farmers by enhancing direct procurement and applying best practices. It also provides cattle feed to the farmers and supports them by facilitating cattle checks through its tie-up with a team of veterinarians. Current inflationary environment is unlikely to have material impact as DDL has taken a price hike of about 4% in Jan 22, broadly commensurate with the industry in order to pass on increased procurement prices. With DDL gaining scale and all the milk virtually procured directly, it's well positioned to maintain double-digit margins on a sustainable basis. DDL is among the few companies in the listed dairy space with a proven track record, strong balance sheet and return ratios, and a high-quality management. It qualifies as one of the stocks to be owned in the portfolio. The stock, if you look at it, has corrected by about 26% from its all-time high in November 21, and we recommend adding the stock to your portfolio. DDL has strong presence for over 23 years in states such as Andhra, Karnataka, Tamil Nadu and Telangana. It outpaced the dairy industry with revenues growing 16% over FY18 to FY20, which is the pre-COVID period. Its milk processing and sales volume grew 16% and 12% CAGR between FY18 and FY20. DDL is gaining market share by entering newer geographies and adopting inorganic route for growth. It has steadily increased milk processing as well as procurement, reporting better than industry growth. On the organic front, its strategy is to expand in markets adjacent to its current area of operations to grow in an effective manner. DDL is penetrating newer markets such as Maharashtra and central Tamil Nadu, and it also plans to enter Odisha. It's also pursuing inorganic opportunities. In 2019, DDL acquired 2 processing plants of KC Dairy, which enabled it to increase presence in Tamil Nadu. Also, it recently acquired Sri Krishna Milks, which has good presence in Karnataka, Western Maharashtra and Goa, which will strengthen DDL's overall presence. It aims to enhance direct distribution of milk to consumers and reduce dependence on agents. It's ramping up Dodla Parlours, which are smaller stores that are company-owned and franchisee-operated, and it has almost doubled the count to 550 as compared to 290 in FY21. It's also supplying milk to premier offline retailers, whether it's D-Mart, Reliance, as well as leading online retailers, the likes of Big Basket and Super Dairy. Increased direct distribution will help DDL have more control over the supply chain and enable better margins in the long run. Currently, DDL derives about 13 to 15% of the revenue from direct distribution. It's also manufacturing cattle feed under Orga Feed. It sells the cattle feed directly to farmers, which enables backward integration. Orga Feed currently has a revenue of about 45 crores with profitability marginally better compared to DDL. The company is enhancing capacity from 2,000 tons per month to 10,000 tons per month and recently announced a capex of 50 crore rupees. DDL aims to enhance Orga Feed's revenue to 200 crores over the next 4 years with an aim to provide cattle feed to a larger number of farmers from whom it sources milk. DDL has enhanced direct milk procurement. Its procurement from village-level collection centres has increased from about 50% in FY18 to more than 90% currently. It has eliminated third-party supplies in Tamil Nadu and Andhra and plans to implement the same across its network. This has not only provided assurance for supplies, but also resulted in procurement at better prices. DDL is also reducing operating costs and investing in modern technology and increasing automation. It's also trying to reduce consumption of water and electricity as well as milk reprocessing. These measures would enhance the overall operational efficiency. DDL's EBITDA margins have improved from about 7% in FY18 to double digits in FY21 as well as 9 months of FY22 period, and it aims to sustain these double-digit margins. DDL has become debt-free this fiscal. Improving cash flow from operations as well as proceeds from the recent IPO enabled the company to repay its entire debt. Currently, it has cash and cash equivalents worth 300 crores. Given the cash nature of the dairy industry, DDL has very low core working capital requirement. It has healthy return ratios with ROE as well as ROCE in the 15 to 17% range. The strong balance sheet will enable DDL to pursue inorganic growth opportunities. At the current market price, the stock is trading at about 18 times its FY24 projected earnings. Given DDL's industry-leading performance, healthy balance sheet, the valuations seem reasonable.